Welcome to Close Option Trading Desk. Today we're discussing one of the biggest questions facing financial markets. Is artificial intelligence creating another technology bubble, or are investors witnessing a genuine productivity revolution supported by real earnings? Let's separate headlines from data. The first thing investors notice is valuation. The S&P 500 is trading above its long-term average multiple, while the Shiller Cape remains above 40. At first glance, that certainly looks expensive. But today's market isn't identical to 2000. Many of the companies driving this rally are producing enormous cash flow. NVIDIA, Microsoft, Alphabet, and several others aren't speculative startups. They're already profitable businesses generating billions of dollars.
Exactly. What's interesting is where the real excess appears. Public AI leaders have actually seen some valuation compression as earnings caught up. Private AI startups are a different story. Many are still raising capital at revenue multiples above 50 or even 100 times sales. That's where investors should probably focus their attention.
Another important number is infrastructure spending. Major hyperscalers are expected to invest hundreds of billions of dollars this year building AI capacity. That's becoming a meaningful contributor to economic growth.
That investment also explains why many AI businesses aren't highly profitable today. Building the infrastructure is incredibly expensive. OpenAI, for example, generated significant revenue while still reporting massive losses because computing infrastructure costs remain enormous.
Right. Investors shouldn't confuse rapid revenue growth with immediate profitability. History shows that major infrastructure cycles often require years before returns fully materialize. The important question becomes whether earnings eventually justify today's spending.
There's another concentration issue. The largest AI-related companies now represent a very large portion of the entire S&P 500. When leadership becomes concentrated, markets become more sensitive to earnings disappointments from only a handful of companies.
Now let's turn to retail traders. One misconception that continues to circulate online is that there exists a single hidden algorithm controlling financial markets. Modern market structure simply doesn't support that idea. Markets operate through millions of participants interacting continuously through order flow.
And that's why evidence matters. Across regulated brokers, the majority of retail traders lose money over a 12-month period. Academic studies reach similar conclusions. Interestingly, many traders actually win more than half of their trades. Their problem isn't accuracy, it's risk management. Average losses frequently exceed average winners because losing positions are held too long while winning trades are closed too quickly.
That's probably the most important lesson. The best traders rarely rely on extraordinary win rates. Instead, they consistently control downside risk while allowing profitable trades enough room to develop. So today's AI market certainly contains areas of speculation. But unlike the dot-com era, many leading companies are supported by substantial earnings and cash flow.
For traders, separating measurable evidence from popular narratives may be the most valuable edge available.
Thank you for joining us on Close Option Trading Desk. If you enjoyed data-driven market discussions, follow us for future market briefings.